how you should think. So for my direct material, what are my direct material? It's the yellow wood. Yellow wood is my direct material. They gave me the number of kgs that I need for 1 unit plus the price per kg. Price per kg. Don't make the mistake to think that this 30 is the price for the 20 kgs. No. It is the price per kg. So to find now what I will need for 1 unit, 20 multiplied by 30, which is 600 Rand, right? Now 600 Rand, now that is for 1 unit. Now for 200 units, 200 multiplied by 600 Rand, which gives us 120K, right? So we're good, 120K. Now, direct labor. How did we get here? Come on, guys. What's happening today? Are you there? There's only Sierra. Come on. Right? So again, Sierra, very good. So 400, because it says it here, that's the direct labor. So the direct labor to produce 1 unit is 400. How many units do we need to produce? 200. So 200 multiplied by 400. What should I need to pull? Do I need to pull a calculator here? But guys, please, are you on your calculators? This is our practice, right? So the fact that you are too quiet, I don't like that. This is our practice session. Are you there, guys? Okay, 20 multiplied by 30 multiplied by 200. Do you see that? Okay. So we good with this. We good with it. Are we good with this? Okay, Ciara is there. But are you there? Because you're too quiet. This is our time for practice. So you get this question in the exam. You cannot be wasting time and looking at the numbers and you don't know what to do. It needs to be straight. The first musketeer, who's our first musketeer? Direct material. I said, you always, when you're looking at production costs, you always need to think about the 3 musketeers. Direct material, direct labor, manufacturing overhead. Direct material, direct labor, manufacturing overhead. Those are, you're hunting for those 3. For production. Non-production, you know, there's 2 categories, marketing, distribution, selling, that is in 1 category. We call just order gating. You can call all that thing order gating. So we know the marketing is involved, the sales team is involved, the distribution, so that we can take that product straight to our customers, right? And then we have the administrative costs. So according to the question that you have in your textbook there, the administrative cost is only 1,000 Rand. I think it's the secretary who's going to be paid, I think, an extra 1,000 Rand. Am I correct? According to the example. This is straight from your textbook. So that's 1,000 Rand. So we know that the administrative cost is 1,000 Rand. The marketing, distribution, and selling, this is the amount. The manufacturing overhead. We say that manufacturing is indirect material, indirect labor. Everything that is indirect is here, manufacturing overhead. Are we clear? So this shows you how you can quickly calculate. You put together the production cost and the non-production cost. This gives you the total. This, if you try with your calculator, this plus this gives you the total. Are we clear on that, guys? Are we clear? I'm really scared today. Okay, okay. Any questions, guys? Any questions? All right, so you can see here, if I add this together, what does it give me? It gives me the total, right? Here is the total. 342,600, right? This is the total. So that's how you'll be calculating. And I don't know, it might be me. I'm just overthinking because maybe some of you are not reacting fast enough for me, right? So, but that's how it's going to work, right? So if you are in the exam, don't waste time. You know exactly what you need to do in the exam, right? So in order for us now to determine profitability, we need to understand how these costs behave as production change. So that's where we move to this. Thus, again, very important concepts. And I would like to see if people understand this concept. Do you understand this concept? Fixed cost, variable cost. Very easy. That's not my main point. My main point is at the unit level, you also need to understand how the costs behave at the unit level. That's the trick. We know that the total fixed cost just is fixed. Like it says, total, it says fixed, the same. It doesn't change. It doesn't go up and down. So it is a cost that remains constant in total. Regardless, remember, it must always be with regards to the production volume. So regardless of the production volume, if you're paying a rent of 5,000 rand, it doesn't matter if you produce 1 million or you produce 500. It doesn't matter. Your rent is fixed at 500 per month. So that's what you pay. We agree on that. But per unit, the fixed costs will act differently. Because if I need to analyze that cost per unit, I will take the number of units that I've produced. Do you see that? The example will be if I'm producing, for example, the rent that I'm paying is 10,000 rand. Let's say I'm paying a rent of 10,000 rand and I'm only producing 1 unit. So I will divide 10,000 rand divided by 1. Okay? But if I'm producing, let's say, 1,000 units, so I'll take 10,000 rand divided by the 1,000 units, which gives me what? 10 rand per unit. So you can see that the cost per unit decreases as the volume increases. The more I'm producing, the smaller the fixed cost is. Does that make sense? Just checking with the class so that we don't get into trouble when we are doing the advanced stuff and we are struggling with things that were foundational. Do you see what we want to avoid? All right, Tandekile, please ask the question.
No, sorry, sir, it was a mistake.
Oh, sure. I thought that you raised your hand there. All right, so are we good? Thumb up, are we good? Like I said, there is no shame. There should be no shame in your game if you're not understanding just now. Let's tackle it now. Then when we come to the advanced learning unit and you are complaining that I don't understand because you simply did not understand some of the foundational concepts, that will be very unfortunate. I will need to say at that time, that will be very unfortunate, right? So if you say you are okay, then we are okay. We can move on, right? Look at the variable cost. What does variable tells us? It means that it varies. So the total variable cost vary. It goes up and down with regards to what? To changes in the activity level or in the volume. So variable cost, if, for example, we produce and it costs us 1 rand, and it costs us 1 rand. If we produce 1,000, it's going to be 1,000 rand. If we produce 10,000, it's going to be the cost of 10,000 rand. What do you notice? It goes up, it varies with the production. But if the production goes down, it also goes down. So we understand. That's the meaning of variable cost. But what is the behavior of the same cost per unit? Per unit. Let's say the total variable cost is 10,000 rand. We need to calculate the unit cost. We need to ask, what is the volume that we produce? We produce 10,000, right? So 10,000 rand in cost divided by 10,000 gives us what? 1 rand. So that's the cost. But if we produced 5,000, 10,000 divided by 5,000 gives us what? 2. Do you see how it goes? So it seems like at the unit level, this cost is constant. At the unit level, it does not change. Does that make sense? Like we said about JCMA, so we will have one cost. Do you see this one? The 30 rand per kg. Absolutely, I like that. I like that. Oh, no. So it's a question. Oh, Tandekile. So why does it remain constant per this is what I said. This 30 rand doesn't change. It's a constant, Tandekile. That's why we say per unit, remember. 30 rand per kg. That doesn't change. It doesn't matter how much we're going to produce. We might produce 1,000 units. This cost will remain the same. Do you see that part? But in total, it's going to vary. From if we're producing 200 units, this is the total. What if we're producing 400 units? Would it remain the same? What would it be if we're producing 400 units? It would be 20 multiplied by 30, which is a constant, it stays the same, multiplied by 400 units, it will be the double. Do you see? Tandekile, does that make sense? Yeah, okay. Guys, can I see the thumbs up? Please don't scare me more. Are we good? Haley, Joshua, are we good with this? And once you grasp it, and that's what you need to do, is not to say, okay, if you still have some uncertainty, go do practice. Out of practicing, you will see that, okay, no, now I've mastered this concept. But it's easy. We've proven. You can see this is constant. The price is constant. For example, when you buy sugar, price is relatively constant for some period of time. You buy sugar, for example, at 30 rand per kg. It's just an example. You're not going to go today to the shop. You ask for the sugar price, they say 30 rand. Okay, tomorrow you come, they say, oh, now it's 50 rand. No, they're not going to say that. It fairly stays constant. It fairly stays constant. So that's what we're saying here. So understand this part. The variable cost, you can understand it's vary, but per unit, it's constant. The fixed cost, you understand that in total, it is fixed, but per unit, it decreases as the volume increases. Isn't that interesting? It decreases as the volume increases, right? And we have all the examples. Shall we move on? And this is the line. So you have the picture. This is the fixed cost. It's fixed. This is the variable cost. It increases And here we are talking about the total variable cost, right? The total variable cost, not the cost per unit. This is the total variable cost. You can see how it's increasing because it is what? It is a variable cost. The name says it. It's a variable cost. It increases with the number of production. Look at the number of production of unit here, unit produced. So if the number of unit produced increases, the cost also increases. We good. That's how you understand the graph. So now if we take this cost plus this cost, we're just going to shift this cost. We put it on top of the fixed cost. It provides us with the total cost. Do we understand that? Do we understand that? Are we good? Now let's move now, for example, to the classification, right? So we have quite a lot of costs in the example. Now, could you classify those costs as fixed and as variable? This is an exercise that I hope all of you have done. And if you have not done, you should be doing. Wood used in production, is it a variable cost or is it a fixed cost? Remember, this wood used in production, we are talking about the total wood that was used in the production. It is a variable cost, right? Why? Because it increased with the volume. You always need to ask yourself the question, why is it a variable cost? Because it increased with the volume. Can you ask yourself the question, if I increase the number of units, will it increase? Yes, then it's a variable cost. Okay? Direct labor, will it increase if I increase the number of units? Yes, then it's a variable cost. The sales representative commission, if the sales representatives sell more, would they get more money? Yes, then it increases with the production. Then it is a variable cost. Wood polish, does it increase with the number of production? Yes, then it's a variable cost. Are you getting it? Is that making sense? Carriage on sales. Do we pay more for delivering more product? Yes, we pay more for delivering more product. Do we buy more glue or nails? Nails. Yes, we buy more glue if we want to produce more. We buy less glue if we want to produce less. Does that make sense? But that will not be the case when it comes to fixed cost. The factory supervisor wage is a wage. It's a fixed cost. We will pay him 2,400 whether we produce 10 times or produce less, it will be the same. The rental, it will be the same. Will it change? If we produce more, is the rent going to go up? No, it won't. Rates and taxes, will they go up if we produce more? No, they won't. The total rate will stay the same. Advertising cost, we pay a fixed amount a month for advertising cost. The assistant salary, especially if she is in the admin building or even wherever she is, it doesn't matter. As her salary, do you get paid more if your company? And by the way, this is a question, right? So do you get paid more if your company gets more money? No. They might give you a bonus, maybe, but your salary is a fixed salary because that's the contract you sign. So we understand now, right? So there are costs that remain fixed because, and especially you will notice is that they come with a contract. All right, so the blueprints for CVP. Now we are talking about CVP. How many units must we sell to cover all our costs? Very important question. How many units? I can ask you that question in the exam. How many units must we sell? How many units do we need to sell to achieve a specific target profit? Can you believe it that your class will be able to calculate all that? What is the impact on profit if we change our selling price? Very good question. What is our margin of safety if sales decline? The CVP analysis will actually answer those questions. But what is it? So it is the analysis. It is a model that helps managers understand the relationship between what? Between cost, volume, and profit. Never scratch your head when you have these questions. It's finance. The answer is in the name, CVP, cost, volume, profit. So what is it? It's just the analysis is to help the manager, right, understand the interrelationship between cost, volume, and profit. That's all. Simple. So, but there is a very key concept in CVP analysis, which would be actually the most important part. It's what we call marginal or contribution margin. And so, guys, I've done this for you. You can see here. So now here we are at the level of a unit. Look at the total cost for 1 unit. Are you with me? Can I have thumbs up? If you are with me, we can move forward. All right. Okay, right. So at the level of a unit, look at the total cost per unit. All this is the total cost per unit. What is it called? Variable cost plus the fixed cost. That gives you the total cost. But the full unit is this one. It's the full unit. This one includes what? The price. So let's say we're looking at the price of a unit. 1 GSS. What is the price? Okay. Within that price, there is 3 things you must remember. There is the variable cost per unit, there is the fixed cost per unit, and then there is the profit. Do you see? So what is marginal income? Marginal income is when we take the price minus the variable cost. So if you remove the variable cost, you are only left with this part here, fixed cost and profit. Do you see this part? We call that the marginal income or the contribution margin. Why is it important? Because this one goes out to pay for the fixed cost. Remember what is the problem for any company. I always told you this. What is the big problem for any company that you have out there? You need to keep the light on. Whether or not you produce anything, you need to pay your rent. You need to pay the fixed cost. The debit orders are coming out, whether you produce or whether you don't produce. And so we need to resolve this problem of the fixed cost. And that's how a managerial accountant is a very clever person, because he says, I need to look at my marginal income. The variable income, it's fine. It's going to be taken care of, variable income, every time I'm producing. I take care of the variable income. The fixed cost, that's the thing I need to kill. Once I kill it, then I can start making profit. Is this making sense? Is this making sense? Right? So when I give you a full price, what are the 3 things you need to remember in the full price? What is the variable cost? What is the fixed cost per unit? What is the profit? Right? And how do you find the marginal income? You take the full price minus the variable cost. You take this out, you cut it out. This is your marginal income. Right? So now, this is how you will understand our formulas. I said, what did I tell you? I said you should be able to tell me what is the break-even point. So if you want to find the break-even point, remember we were talking about that marginal income or contribution margin, marginal income or contribution margin. How do we find the marginal income again? I just showed it to you now, here, right? I just showed it. How do we find it? We take the selling price per unit minus the variable cost per unit. The selling price per unit minus the variable cost per unit. Why? Because we want to have this part. This part is very important to us. You see, you can never memorize a formula. Don't just blindly memorize a formula. If you understand this, there's no need for memorizing. Because to calculate now the break-even point, what do? You take the total fixed cost divided by this marginal income per unit. That's it. Once you have the marginal income, you take the total fixed cost divided by the marginal income per unit. All right? Why is this important? Because this is going to calculate the number of units you need to sell to generate zero profit, but also zero loss. Remember what was the definition of the break-even point. The break-even point is the point where you arrive, where you are not making a profit yet, but you are no longer making loss. You are no longer making losses. You have arrived at that point where everything above that point becomes pure profit that is coming in the company. All right, so now that we are done with the theory, let's look at LECIMA, break-even point. Remember our total variable cost that we found. You remember the total variable cost? Remember the total variable costs, right? So here is where we added everything. We added all the variable cost and we have the total variable cost. Do you see it? Total variable cost, total fixed cost. Total variable, how did we get it? We classified. We looked at all our costs and we divided. These costs are variable costs, these costs are fixed cost. So we had the total fixed cost and the total variable cost. Can you see it? Are you awake? Are your eyes wide awake? Perfect. Can you see it? Right. I want that thumb up. All right. So now, here is the practical part of it. So we take the total variable cost because we need to find the variable cost per unit. We take the total variable cost divided by the number of units. This gives us the variable cost per unit. This gives us what? This portion here. The variable cost per unit. Do you see it? VC, variable cost. I trust I'm making myself super clear, right? You take the total variable cost, you divide by the number of units, you will get the variable cost per unit. That's the first part of you calculate the variable cost per unit. Now we calculate the marginal income. That is step 2. Calculate the marginal income per unit. What do we do? Marginal income, what did we say we're going to do? We take the selling price minus what? Type it there in the chat, just for me to make sure you're live. Guys, I'm worried. Yeah, Ciara is correct, but you guys are taking too long. Kandekile, it's variable cost. It's not CVP. All right? Variable cost, you take the selling price minus the variable cost, which I just showed you. Yeah, I showed you. Because we want to find this, the marginal income or contribution margin. Yeah? Marginal income per unit. This is the marginal income. So now, how are we going to find the break-even point in units? In unit, we said we need to take the total fixed cost. We know what the total fixed cost is, 20,000 rand. We calculated that 20,000. You remember? Here it is, here it is, here it is, here it is. Total fixed cost divided by what? By the marginal income per unit. It will give you the number of units you need to produce for you to break even. So obviously you can't produce half. That's why you always need to round up to the unit. So in other words, if we round up 14.42, it's going to be 15 units. So that will be in your test. So let's see, my furnishers must sell 15 units per month to break even. Okay? You can't produce half of a unit, right? You understand the concept. We can't produce half of the unit and we sell it, right? So that's why we need to round up. But we understand, more or less, we need to sell 15 units in order to break even. Now, let's say we have a target. Let's say Joshua needs to get a profit of 80,000 rand. So if you want to set a target, you're going to do the same formula we did for the break even. Remember, we used the total fixed cost divided by the marginal unit. But this time, you need to add to the total fixed cost the target profit. That's it. Simple. Do you need to memorize this? No. This is something you can't even memorize. It's logical. Are we good, guys? So the total fixed cost, 20,000, plus the target profits we want. You see? So every time Ciara would say, no, I want to get a profit this month of 80,000 rand. Ciara must say, okay, what will be my total fixed cost? 20,000 rand plus the 80,000 rand I want to get. So 20 plus 80 gives me 100,000 divided by my marginal income per unit. That will give me an idea of how many units I need to produce in order to reach that target. Yes, I had to take 15 minutes more to make sure that class understand this because, like I said, why is it important? It's foundational. So you can see, once I reach the break-even point here, everything above becomes profit. It's almost like that line you need to cross. Once you cross that line, that's it. You're in the good. You're in the green zone. You're in the green zone, right? So what did we cover today? So first of all, we built a toolkit and you have been empowered to understand what is cost classification, cost behavior, and CVP analysis. What I want you to do is, if you have not completed Learning Unit 4, that you go and complete it properly and read and understand. If there's anything that is fishy, that is not sounding correct, please ask the question on our social. Put the question, let's work together, right? Are we good? I'm going to stop this recording and the lesson is considered done and understood, right? If you have any questions, guys,